This is TreppWire Week in Review for the week ending October 11th, 2024. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer, and Stephen Bushbaum, Research Director. This week, Florida prepared for yet another hurricane to make landfall, and we saw that occur Wednesday night as a Category 3 storm. In other news, the market was awaiting a new CPI reading, but maybe not as closely as they have in the past. The reading came in on Thursday at 2.4% in September, which topped expectations. And we saw jobless claims hit the highest level since August 2023. So Lonnie, Steven, let's talk about the week's headlines and tie it all back to commercial real estate.
So let me start off by saying my heart goes out to all of those affected by Hurricane Milton. I myself was impacted by Hurricane Helene and the local area. I can't even imagine the magnitude of damage that Tampa and that area faced, given what I saw personally on the ground in South Carolina. And so my heart goes out to you. It certainly has been an interesting week. If you remember, coming off of last week, we were waiting for non-farm payrolls. Those came in a lot stronger than everyone anticipated. So over the last 5 business days, the 10-year Treasury has sold off about 25 basis points, which is quite fitting given, drumroll here, Lonnie. Do you know what this week just capped off? It's a little bit of a slice of life weave in.
Yeah, I don't, Steven. So why don't you enlighten me here? I hear the drums gently drum rolling in the background.
This week was Fat Bear Week, the conclusion of Fat Bear Week, where you vote on the bears, and it's like a March Madness bracket of bears, and you vote for which one has gotten the fattest. You know, they're fattening up on salmon for the winner, and so the winner this year was Grazer, who beat out Chunk, which was pretty fitting, considering I read, apparently Chunk killed one of Grazer's cubs, which is, okay, that's pretty morbid. But the bottom line being, Treasuries have sold off 25 basis points in the long end of the curve during Fat Bear Week. That's just the irony every year for what happens during Fat Bear Week is it never ceases to amaze me. Anyway, that was it's certainly a bit of a painful repricing of the market. And if we look at the CME FedWatch tool, there's been some wild repricing in the market for what's going to happen with the Fed. If we roll back the clock a week ago, there was a 32% chance, or at least traders were betting, there's a 32% chance of a 50 basis point cut. That's now dropped to 0%. That has basically just shifted into the likelihood of a Fed hold for their November 7th meeting. And that's being priced at roughly an 18% probability right now. So really interesting repricing in the market. The short end of the curve has held up a lot better. And so we've actually steepened across the curve. Honestly, if I'm a commercial real estate, borrower looking at refinancing here, the belly of the curve, the 5-year, still is the most attractive option, which kind of fits with what we've been seeing on the issuance side. 5-year issuance has been extremely strong. We look at today's CPI print and jobless claims. The CPI print, I don't think that was a huge event, honestly. I mean, the Fed's been saying it's going to be a bumpy road on disinflation. This, to me, is just one of the bumps. And then the jobless print, that really kind of countered some of the sell-off you would have expected from the hotter CPI print. So that jobless claims coming in higher, largely probably driven by the Hurricane Helene event, and now what we're likely to see with Hurricane Milton, it's sort of like a lot of noise. So a little bit of a teaser here. I think I'm going to have to write a parody for How the Grinch Stole Christmas that ties into the Fed. And just to give you the first verse of it here, not to be too tongue-in-cheek, but I think I'm thinking something along the lines of, for over a year now, the Fed sat on high, watching the markets with a very keen eye. They'd scrutinized data, both noisy and clear, and whispered, "We've seen this for over a year."
Man, Steven, you're coming in hot today, man, I'll tell you. I think this is what happens when your power goes out for a little while and you have too much time on your hands. But I did actually see a blurb now that you brought up the Fat Bear Week. I did see a little bit about that, and your point, the bear that won this year was exacting a little bit of revenge over Chunk. I didn't know we were going to get to that level on the podcast today, but hopefully for our listeners, if you didn't know about Fat Bear Week, you can do a quick Google search and you can get educated pretty quickly. So, it's an interesting time in the market. I mean, I remember for the last several months when CPI print was going to come out, I mean, most major news networks or on Twitter, you would see countdown timers. You would want to know exactly when the inflation number was printed. And to your point, Stephen, it's kind of a non-event. Now, justifiably so maybe this week with the Hurricane Milton hitting Tampa Bay area. And Obviously, our thoughts, are with everyone that's affected with that. I mean, it's second hurricane in a period of a couple of weeks to go through Florida. And it's just really interesting, the dynamic here of storm that's identified as a hurricane intensifies to a category 5, makes landfall fall as a category 3, but just dumps insane amount of water on devastated regions that have already been impacted. It's going to test the resiliency of borrowers, owners, lenders, insurance carriers, government officials. I mean, this is something that's going to take some time to play itself out. So obviously, if you're impacted from that, our thoughts are with you. If there's anything that we can do to help, we'd be happy to help in whatever capacity we can. It's a devastating time for the people in Florida, and it's really challenging in the sense that Florida's had such a great run coming out of COVID, and so many people have moved there, and the economics of the state have really benefited from that. And I think this has the potential, at least, to maybe reverse some of that positive trend. I mean, some people may say, yeah, we've been there, done that. 2 hurricanes over a course of a month is enough for me. I'm going to go back to wherever I came from or move somewhere else. It's just not worth it. So, we'll see what the lasting implications are for the state. But, early estimates about 175 billion in damage were some of the numbers being tossed around. Some people were saying 50 billion. We've put out a piece today that kind of looks at MSAs that were affected and gives some perspective on what the potential damage could be from a CRE point of view. And so it'll be interesting to see over the next coming days and weeks just what the damage actually is. But you look at this and Hurricane Helene that ravaged Florida and all the way up through North Carolina, really tough couple of weeks there. So, to kind of get back into just the CRE landscape and kind of talk through some of the stuff you were mentioning, Stephen, the inflation stuff, as we mentioned, I think is kind of a non-starter at this point. Like, nobody's looking at that anymore as the main indicator. The Fed has already made the pivot. Now all eyes are on the Fed at this point. I think less attention is being paid to CPI in its pure form. They've kind of set themselves up for high expectations for continued decreasing rates, but this doesn't bode well for them in the sense that inflation came in about 0.2% higher than what I think the Dow Jones had consensus forecast on. And you see people seeking unemployment benefits were at incredibly high numbers. So you're getting this mixed signal again of like super softness in the labor market, even though non-farm payrolls were strong, and then inflation that came in hotter than expected. So I say this every week, it feels like, but the data is a mixed bag, and it's really going to come down to kind of what persists over the next couple of weeks for the Fed to try to make a decision on what they're going to do going forward. So we have a lot of content to get to today. We put out a lot of research over the last couple of weeks, so looking forward to diving into some of those topics.
Just to touch back on the impacts of Hurricane Milton and also just what we learned from Hurricane Helene. For you, Lonnie, based on what we've seen on insurance repricing over the last, say, 3 to 5 years, I mean, do you think this just adds another, say, looming data point for borrowers on what insurance costs are going to adjust to? Specifically, like if I think about what's going on behind the scenes at insurance carriers with actuaries basically remodeling and what's probably going on at their data vendors, who they're relying on for these climate models, the rapid strengthening and scope of these storms to me is really highlighting what's possibly going to happen in insurance repricing in those markets. And so while we had seen insurance prices level off, I can't help but wonder potentially we're going to see in 2025 and 2026 come back with, again, another round of some painful policy adjustments.
Yeah, I mean, look, this is unprecedented at the insurance level. I mean, first, we have a federal government that effectively says FEMA funds are depleted. We don't have FEMA funds available. Then there's mixed signals, and they're saying we do have funds available. But the rollout of that, the ability for people, because the cell service is down or there's no power, there's no way for them to communicate, is very difficult. They can't even apply online because they have no power or internet. And to your point, the intensity of these storms is just unprecedented in recent history, right? So I think there's a couple of things that are in play here. The primary one is, are these insurance companies going to be able to even remain solvent, right? Is that going to happen? Yeah, if the answer is yes, are they going to stay in those markets, or are they going to pull out of those markets completely? I think that has some pretty significant consequence. If they stay in the market, to your point, premium increases are coming down the pipe. If they don't stay in the market, that's going to beg a whole another set of questions in terms of where are you going to actually get coverage from. I think the more impactful one, though, is actually broader than just the line item expense of insurance. It's, do borrowers, do people want to be in those markets going forward? And I think that's the psychological challenge that we're going to see play out real time here, is if you're a storefront owner, and even if the insurance company makes you whole on your existing building and you're able to get out, do you just go open your business somewhere else where you don't have to deal with this? I mean, we've had a number of people over the last couple of weeks talking to reporters and others that basically say this is like an every 2-year event for some of them, where they're having to completely rebuild their storefronts. And at some level, I think people's just will to do that probably diminishes to a point where they go somewhere else where that's not an issue for them. So I think from our perspective as a data vendor, the CRE insurance premium risk is very real. We'll obviously be monitoring that real time. But I think more broadly, you may see a paradigm shift in just how people perceive the benefits of living in Florida relative to the risks that are associated with that. And so I think some benefactors may be Texas and others, where for the last several years, we haven't really had the detrimental impacts of hurricanes like we see in Florida, but we have some of the same business-friendly tax policies and other things, maybe an exodus of people from Florida coming to Texas or other like-minded states.
So as Lonnie mentioned earlier, we did put out a research piece highlighting some of the MSAs impacted by Hurricane Milton. One of the top ones on everybody's mind was Tampa, Florida. Now, Tampa has roughly just a little over $16 billion in securitized commercial real estate debt outstanding, and of that, approximately $1 billion matures within the next 12 months. We also put out stats regarding the delinquency, special servicing, and weighted average debt service coverage ratios for the 3 major metros impacted by Hurricane Milton. If you're interested in receiving a copy of that report, please reach out to us at podcast@trepp.com, and we will get you a copy.
And another piece of research that we released this week was our monthly special servicing report. We track commercial mortgage-backed securities and bank loan distress in a variety of different ways and reports. Last week, we talked all about our CMBS delinquency rate and our bank CRE loan delinquency report. This week, we have special servicing, and we saw that the special servicing rate rose substantially in September. It jumped up 33 basis points to reach 8.79%. So talk to us about what this means and what we saw across some of the property types.
This is an interesting research report that we put out, Haley, in the sense that we've had 9 consecutive monthly increases, and this month's increase is the second largest uptick in 2024. So if you look at this, we're going to break it down and talk a little bit about this, but driving the overall increase in September was, shocker, the office sector, which surged 67 basis points to 12.58%. So just to give some historical context here, the high water mark during previous disruptions for special servicing was 14.7% back in May of 2012 for the office sector. And again, this month's reading was 12.58%. So we're not quite to the highest recorded special servicing rate for that sector, but we're getting, eerily close. Multifamily rate also rose 36 basis points to 6.07, which surpassed the 6% mark for the first time in nearly 9 years. So we just released our delinquency report not that long ago for September. Delinquency for the office sector in September was around that 8% mark. Multifamily was around that 3% mark. And here you see special servicing at some multiple of both of those. So it'll be an interesting trend for us to continue to watch if some of those specially serviced properties continue to not be able to cover their debt service, and if they fall into that delinquency category, or they have some additional challenges that they have to deal with upcoming maturities, et cetera, et cetera. So I know, Stephen, we looked at all the major property types. Maybe you give us some perspective on what you saw across the other sectors as well.
Sure. So the office rate now is up more than 200 basis points over the past 4 months alone, which is just massive. Like you're saying, Lonnie, the trajectory on this rate has been really kind of staggering to watch. The retail rate reached a near 2-year high of 11.22%, and the lodging rate hit a 2-year high of 7.84%. So some really staggeringly high numbers, given how low the delinquency rate is. That just kind of speaks to the pain on the refinancing side. If you recall, the September delinquency rate was 5.7%, but that excludes loans that are still current on mortgage payments but past their maturity date. So if we included those loans that are past their maturity date but still current on mortgage payments, the delinquency rate would have gone from 5.7% up to 7.15%.
It's just tale of two cities, right? I mean, like the distress is real. The headlines are not just hyperbole. Like the distress is real, but the delinquency numbers are low. But if you look at all these other like storm cloud metrics, special servicing, non-performing, maturity balloon type of deals, it's real. I mean, like 12+% special servicing rate for the office sector, as we mentioned, is a really, really high number. I mean, the only other time it was higher than that was several years ago. I think we're going to start seeing some of these things trickle down through the delinquency side of the equation. So it's just interesting, Stephen. I've seen a bunch of memes online and people making jokes about the Fed cutting rate 50 basis points and the 10-year going up, and people not really comprehending how that can happen, right? So like I've also seen a lot of other things, transaction indices and other things like indicating that there's been an uptick since the Fed reduced rates. And like I just have some thoughts on that. Like one, it'd be way too soon to actually be able to calculate that real time because commercial real estate transactions are under contract 60, 90, 120, 180 days before they actually close. So anything that's closed in the last 2 weeks was already under contract prior to the Fed pivot. And two, we're seeing the downstream implications where just because the Fed lowers rates doesn't mean interest rates are coming down. And to your point, like in this instance, the 5-year money market is where you want to be. You want to lock that in for 5 years. It seems to be the sweet spot. So there's just a lot of moving parts here. And it's just like we said on the macro stuff on the intro, there's not a lot of clarity around what to do here. I mean, if you're in capital markets and you're advising clients on how to structure a finance deal right now, you're having to look at all these things. You have people think in their mind, well, the Fed just cut rates and my interest rate's going to be cheaper. It doesn't by definition mean that's the case. You're going to have to find where the money is good. And at this point, it maybe looks like a 5-year, which isn't too much different than what the advice would have been 6 months ago. So it's kind of an interesting time. And I think for us, like as we continue to monitor these things month to month, I still think there's more pain and distress built into the market. I think we're going to see office special servicing rate eclipse 13%, eclipse 14%. I just think it's there.
Yeah, I mean, I'm with you there, Lonnie. I think we're going to continue to see a lot of distress. I'm also interested to see where the REITs step in here. It seems like they've been very tactical in their deployment of capital, and they've had very attractive financing options in the unsecured market. I mean, basically, they're able to issue debt very, very easily, connect very quickly. And so this seems like a market that's primed for a lot of REIT action and acquisitions. So I'm curious to see how that plays out and if it kind of sets a floor in place for pricing, assuming we pull off the soft landing. I mean, this is all conditional on a soft landing economy.
Yeah, it's a term we haven't heard as much over the last couple of weeks as the soft landing narrative, right? I think people are still, you feel the engines or the turbines on the airplane shutting down a little bit, but you haven't hit the runway yet. And so might be a touch and go. We might not actually make a landing. It's kind of interesting. So a couple of other things to cover from this week. We also released our CMBS loan loss report. This is the part 2. So just to give some high level numbers. And again, if you want a copy of this report, you can email us at podcast@trepp.com. and we'll be happy to send you a copy of that report. But in September, there were $252.5 million across 15 loans that were resolved, which resulted in about $139.5 million in total losses. The average loss severity across those deals was 55.26% for the month, which was an increase in the loan loss volume from August, where we saw total losses at $47.2 million. So if you look at this on a 12-month average, the disposed balance moved to $266.3 million, down from 277.7 that was seen last month, while the 12-month moving average loss severity stood at 63.54%, slightly up from 63.28% in the previous month. So this was, if you want to find some silver lining, maybe some silver lining on the average loss severity this month, but these numbers are still abnormally high relative to non-distressed times.
So Lonnie, the largest loan that resolved with a loss in September, this is an interesting one. This was the $44.7 million Central Eastern Industrial Pool mortgage loan. Now, this was backed by 13 industrial properties totaling 2.1 million square feet in 9 states. It was originally issued for $89 million. Now get this, Lonnie, the loan was originated in 2007 by the long since defunct Wachovia This is wild that we still have a 2007 loan hanging out there, and there's still a few more others. So this loan was transferred to special servicing in 2010 for imminent default, and the properties became real estate owned, or REO, via deed in lieu of foreclosure in July of 2018, so 8 years after special servicing transfer.
Yeah, it's really crazy. I do sometimes just for fun go in and do an advanced search in our Trepp CRE platform and look at all the outstanding CMBS 1.0 loans that are out there. And the numbers dwindling. Most of these are working themselves through the system. But to your point, I mean, 2007 to 2024 is some crazy stuff in the CMBS world. So, at least this one's resolved. Obviously, the result is not great, but we can check this one off the books and it's no longer going to be hanging out there. So, but we have a lot of that data. We actually have some folks that play in that space exclusively, and they love getting into our tools and seeing what's out there. And obviously, there's a lot of commentary and a lot of history with these loans because they're so far past their maturity date and still just hanging on. So, hopefully we'll start to see a reprieve at some level with some of these losses going forward. But as we just mentioned, you combine the delinquency, special servicing, and all the distress that's in the market, I think we're going to have a long road here on the loan losses as well.
And just got to give a quick shout out to any of you listening to this podcast, they're CMBS traders and feeling a little bit nostalgic right now over that Wachovia shelf. To anybody else who traded in that Wachovia 2007 C30 deal, this shout out's for you. You know what I'm talking about.
That was back when you were like on the desk, right, Steven? I mean, around that time period, weren't you doing some work on some of those distressed CMBS deals back in the day?
Yes, and that deal had some hair.
All right, so let's turn to our property type stories of the week. We will start with the office sector. We've been doing that a lot lately, but there's a lot of news there. We saw 2 tenants in Midtown Manhattan expand their leases at 101 Park Ave. So talk to me about the story.
I'm going to jump in quick on this, and I'm going to steal the good news from Steven on this one, Haley. So Corient and Customers Bank are both increasing their footprints, adding a combined 50,000 square feet to the building at 101 Park Avenue. Corient will now occupy 77,000 square feet, up from their previous allotment of 52,000, while Customers Bank is growing from 12,000 to 37,000 square feet. So that's a really nice sizable uptick for them. And that data comes to us from Crane's New York business. So we are starting off with some positive news in the office sector, which has been somewhat hard to come by over the last several months.
Well, you definitely got first mover advantage on that one, Lonnie, because now I'm taking the vacancy challenges. So in September, we wrote that 2 other tenants at that same building, Tiger Management and Morgan Stanley, were set to vacate over 100,000 square feet of space that they collectively occupy at 101 Park Avenue. This coming to us from Crane's New York business. Tiger leased 53,000 square feet under an agreement that ran through the end of September, and Morgan Stanley occupied 49,000 square feet under a lease that rolls in December. The property was 95% occupied as of the first 6 months of the year. Following Tiger and Morgan Stanley's departure, occupancy would have declined to 86%, but for the lease expansions for Corient and Customers Bank will help offset some of that occupancy loss.
Yeah, so this is what we would term as a mixed green here. I'm not sad that I took the good news part of that story, Steven. So I think you did a good job of bringing in the bad news in a positive way. But this property is a 1.2 million square foot building. It was developed in 1982. It has a $365 million loan that backs it. I mean, it's part of a single asset deal. So, I think the positive takeaway here is that they have seen some leasing activity after some of those larger tenants vacated. In this market, you'll take whatever small scraps you can get on the positive side. And, luckily for them, they have a diverse tenant mix. So even though Tiger and Morgan Stanley left, their occupancy, was down at 86, not 56 or 66. So pretty positive story here. We'll see if there's additional leasing activity over the next coming months for this building as well.
Well, since I've clearly taken the negative side of the scale here, I might as well continue. The 10 South Broadway office in St. Louis has seen its value dropped again, and that valuation is now below its outstanding loan balance of $16.1 million. The delinquency status on the 10 South Broadway loan has now showed non-performing matured balloon. The collateral is a 423,000 square foot office in St. Louis, Missouri. The property was appraised at a value of $26.8 million at securitization in 2013. In 2023, the value declined to $16.8 million, and now the most recent valuation shows a further drop to $11 million, which is below the outstanding loan balance of $16.1 million. The loan transferred to special servicing in May 2023 for imminent default prior to the August 23 scheduled maturity date. The borrower had requested a loan extension but ended up not accepting the extension terms provided to them. A receiver was appointed in October 2023. Servicing commentary states that leasing efforts include KPMG, the third largest tenant with 10.5% of the space, deciding to stay at the property and not invoking the early termination provision, which allowed them to leave in 2025. Instead, KPMG will downsize to 34,000 square feet from just over 44,000 square feet, with scheduled rate increases through its lease expiration in June 2028. In 2021, we wrote that the law firm Greensfelder, Hemker, and Gale, the top tenant with 21.3% of the space, had a lease that was supposed to end last summer, but the firm renewed its lease until 2030. In the first half of 2024, the loan posted a DSCR based on net cash flow of 0.59 times, with occupancy at 64%. DSCR first fell below break even in 2022.
Yeah, this is a tough story, and that market is really challenged right now. So it sounds like the lender was willing to give an extension, but the borrower didn't like the terms of the extension, and now here we are. So it's one of those markets where you really got to do the due diligence as an owner, because throwing good money after bad in this scenario is very plausible. And so it sounds like they've decided to hold out, and you see that deterioration of the appraised value. Not a very strong market, and these buildings, this is not the only one in that market, are going to face a long, arduous task to try to get back to some sort of stabilized occupancy. I think at this point, their occupancy fell to about 64% and has not recovered. So it'll be interesting as we kind of watch these markets reinvent themselves, what they're able to do. But that St. Louis office market, we've covered a lot of stories there. There's been a lot of distress, documented distress, a lot of auction sales, foreclosure sales, et cetera. This property potentially ends up something like that.
Yeah, I completely agree with you, Lonnie. If you look at this market and the large blocks of space we've seen be put out for lease or sublease, you have to think that at this debt service coverage ratio, this occupancy, the borrower's put option is too deep in the money. So if the special servicer came back requesting a large pay down, that just didn't make sense at all.
Yeah, they're going to put that capital to work somewhere else. And so, this is one of those scenarios where the bank may end up with a building, or as we've talked about over the last couple of months, they may strategically try to offload this, cut the losses, and move on down the road. I mean, this is one of those where if you could find a buyer willing to take this property on as a lender, that's probably pretty appealing, because the prospects of getting this leased up, the prospects of this actually returning to some sort of strong performance in the short term is going to be very challenging. So Haley, we're going to finish up with one more office story here. We had talked on the podcast about a month ago, about maybe 2 weeks ago, about Nuveen selling an office in Brickell for $443 million, but we didn't have the specifics. We put it out there. We had a listener reach out and say, hey, it's great that you talked about this. Give us the details. So here are the deets. Morning Call Management paid $443 million, or $646 a square foot, for the 685,000 square foot 701 Brickell office building. This is in Miami's financial district. The Boca Raton, Florida investment manager bought the 33 property story from Nuveen Real Estate, which had acquired the asset back in 2002 for, look at this, $172 million. So this isn't just a green shoot. This is like someone put up the bat signal. This is a really, really strong story. And it's obviously its location. I mean, Brickell has been on fire regardless of property type over the last several years. But they purchased it in 2002. They were able to exit in this market at $443 million. JLL Capital Markets brokered the deal. Building had served as collateral for a $184 million loan with a 10-year term that Northwestern Mutual had provided back in early 2016. This property was built in 1986 and underwent $30 million of renovation, and currently sits at just over 90% leased. So Stephen, this is a really great segment for the Florida office market, for just office in general. It's been a long time since we've seen an office property trade in that $650 square foot price range.
And in part, at least correct me if I'm wrong here for my perception, but the new commuter line that they put in has been a huge benefit to that market, because anybody who's driven through Miami, and it's been years since I've driven there, the last time I did, it was an absolute nightmare. And so having that commuter rail in there I think has helped out a ton in terms of tenant demand and how attractive these leases are. Assuming you're within walking distance to that line, which I don't know exactly how close 701 Brickell is, but that market has done extremely well since that line has been put in.
Yeah, I mean, really bodes well for just the narrative around transit-oriented development. I mean, when you're in grad school and you're learning about TODs, everyone says it's accretive to be on a rail line or to be on some sort of transit. And to your point, in this Miami corridor, they've definitely seen the benefits of that. And I know I said that was going to be our last office story, but we had one or two other transactions that are really good news, and I want to try to squeeze them in real quick. So Drawbridge Realty paid $185 million for an office building out in Santa Monica. Equates to $819 a square foot. It was a 225,000 square foot Arboretum Gateway office property. San Francisco investment manager purchased the property from Clarion Partners. They had acquired the property back in 2004 for $95 million. The Arboretum Gateway was built in 99 at 220 Colorado Avenue, about 14 miles west of LA. It's on a triple net lease to Universal Music Group, which recently signed a long-term extension. So another really positive office sale transaction story. Again, this is in a strong office market right now in that Santa Monica kind of enclave outside of LA, $819 a square foot. And then last one here, Stephen, we'll get your thoughts on this. This is down in San Diego. A venture of Harbor Associates LLC and F&F Capital Group purchased the 211,000 square foot Highlands Corporate Center in San Diego. The venture bought the 5-building property. It has a range of addresses from 12730 to 12780 High Bluff Drive in the city's Tony Del Mar Heights area. From the Equity Office Properties operation of Blackstone, say that 5 times fast, which had assumed it nearly 10 years ago through its acquisition of part of GE Capital Real Estate. Said to have paid $77 million for the property, or $365 a square foot. This latest transaction was arranged by Eastdil Secured. The property currently sits at 90% lease. So again, another strong occupancy set of buildings. More than 40 leases totaling 150,000 square foot have been signed there over the past 3 years. Meanwhile, the corporate center, whose upper floors include balconies, have been extensively renovated in recent years. They've also refurbished the lobbies, the conference facilities were added, and they added a fitness center and tenants lounge. This is another story where amenitizing buildings or leveraging the amenities that are already there in the form of balconies, et cetera, really pay some dividends. And I know from my experiences in the San Diego marketplace, that's one office market where if you have balconies, people actually use them because the weather there is perfect every single day. And so it's kind of cool. I was at a conference, the NMHC last year, Stephen, out there in San Diego, and did a presentation. And it was actually hosted at Mr. A's. And you could walk out on the balcony and you actually see all the planes landing at the airport right there. It was a really great scene at sunset. So another just positive office story, 365 a square foot, doesn't compare with the 819 and the 650 that we talked about earlier. But given where we've seen some of these transactions, even in San Diego, another really strong signal for the market.
Yeah, I mean, the leasing numbers that you tossed out there, that's incredibly impressive. 40 leases totaling 150,000 square feet over the past 3 years. I mean, that's phenomenal traction. And I guess that's really what it takes ultimately to move the needle in today's market to fetch, these high prices. When you read off the dollar per square foot of that Santa Monica office property, that is hot. But also interesting to see Clarion on the opposite side of that transaction. It seems like, we've talked about them a number of times over the last 6 months. They've been incredibly active. So, good to see them reshuffling. Interested to hear, maybe if anybody from Clarion Partners is out there listening, I'd be very interested to hear, what you guys are up to this day and age, because it seems like you've been very active and very tactical in your execution.
Yeah, so we actually have some of our Texas Tech alums working at Clarion, Stephen. So hopefully they're listening to this and they'll give us a text or a LinkedIn message or whatever and give us some perspective.
All right, let's turn to some retail stories. We saw the $18.1 million Commons at Madera Fair transfer to the special servicer for defaulting on its balloon payment at its September maturity date.
Yes, the delinquency status on this loan now shows non-performing matured balloon. Previous watch list commentary states that the borrower has been working on a refinance of the loan. The collateral is an almost 300,000 square foot community shopping center in Madera, California. The property was built in 2008. The asset was appraised at $28 million at securitization in 2014. In the first half of the year, the loan posted a DSCR based on net cash flow of 0.92 times. Before this year, the loan had previously only posted DSCRs above 1.0, and specifically in 2023, the DSCR was at 1.23 times. The property is showing full occupancy and makes up just about 5% of a 2014 CMBS deal.
You know, it's really interesting, Stephen. We've talked at length about how strong the retail market has been broadly. But this highlights how every property is unique, every market is independent, and as we've said 100 times, real estate by definition is a local and sometimes hyper-local endeavor. So even in the strong retail segment, you're having some properties that just aren't able to perform for various reasons. So speaking of special servicing, Stephen, we're going to transition here. We call that a segue to the multifamily sector where we had some special servicing transfers. So 2 loans tied to multifamily were transferred to special servicing this week. The first here is the $24.2 million Trinity multifamily portfolio, which was transferred at the beginning of September due to payment default. The loan is backed by 7 multifamily properties across Chicago, Illinois, Sierra Vista, Arizona, Valdosta, Georgia. Although the properties span 354 units, in the 12 months ending in March, the loan posted DSCR at net cash flow of 1.29x. The loan is scheduled for maturity in January of 2030 and makes up a very small percentage of a 2020 deal. And then one more, Stephen, and I'll get your comments on this. $33 million Brush Factory Lofts was transferred to special servicing back in August for payment default. This loan is not scheduled to mature until November of 2031. Delinquency status on the loan switched to more than 90 days delinquent in September from the 60 days that was reported in August. It's a 151-unit mid-high-rise multifamily property in Philadelphia that was built in 1920 and renovated in 2020. The asset was appraised at $48.6 million at securitization back in 2021, and through the first 6 months of 2024, the loan posted a debt service coverage and net cash flow of 1.7 times, with occupancy at 92%.
So just a couple quick thoughts here, Lonnie. First, I gotta just revisit the data comment because, you know, Valdosta, I can't help that one. But yeah, that last story that you read off, that's really interesting because I feel like we've had a number of multifamily loans that we've talked about here over the last, month, 2 months that were 2021 vintage that have run on tough times already. I don't want to say it's anything causal or trend to highlight. It's just at this point observational because you and I have both talked about that 2021 vintage is perhaps one to watch given that we are reaching peak inflation, peak rent growth, right ahead of essentially a large amount of volume coming online in the apartment sector, some rent deflation, rent deflation, and expense inflation being a very painful combo. So this is just something that I think we'll keep our eye on here in the coming episodes to see if we keep seeing this trend tease out of some of these 2021 deals with early defaults.
Yeah, I think we're going to. I mean, this is, to your point, like there's maybe not causation at this point, but the reality is like we're going to see some more of these stories coming through in the sense that peak pricing, aggressive rent growth underwriting, and like this property portfolio that we're talking about here, I mean, 1.29x, it's covering debt service through operations, at least at the portfolio level, but there's obviously some additional challenges that are being incurred. So it'll be interesting to see as these properties play themselves out. We're starting to see what I think is probably some early indications, and there was something on Twitter this week that I read that I thought was, timely. It was like, don't let discount pricing today relative to the peak pricing of 2021 or whatever indicate that you're getting a good deal. Like you still have to do your due diligence. You still have to underwrite what's in place. And I think a lot of people are just now realizing how much some people overpaid for assets during the run up. And as we know, it just takes a little bit of time for those things to trickle down.
So that loan we just talked about was a refinance and had a $1.9 million cash out on equity and also funded about $850,000 in closing costs and just under $100,000 in upfront reserves. And so, it doesn't matter if it's an acquisition at peak prices or a cash out refi. I mean, those are kind of equal footing for loans at risk of early default, at least in my personal experience.
Yeah, the cash out refi, it's like everything else. It works until it doesn't, and if you go back and look, we can show you through our data. I mean, there was a period of time where every deal that refi took out sizable amounts of equity in the refi. And for a lot of people, they were able to redeploy that capital and turn that into some increased gains. But for the last person holding it during the peak, when they refied out and took the cash out, it just becomes an overly burdensome cost of capital at that point going forward. And I think that's what we're seeing on some of these deals.
And everyone's most requested property type. We actually have a lot of transactions in the industrial space today, so we'll run through some of those quickly.
Yeah, industrial properties. We don't talk about them enough. We always get feedback that we don't talk about them enough. So in this instance, I don't know if we should slow play this and just talk really slow. So it feels like we're talking a little bit longer about industrial, but some good news and good stories here. So there's a recently built industrial property in Florida, in Hialeah, Florida. Ares Industrial Management bought the Miami Midway Park Industrial Complex for $147 million or $290 a square foot. This comes to us from the South Florida Business Journal. The Denver company purchased the 505,000 square foot property from its developer, which was a venture of Butters Construction and Management of Coconut Creek, Florida, and Graystar out of Charleston, South Carolina. The Miami Midway Park was recently completed and sits on just over 23 acres at 9695 Northwest 174th Street. And current tenants include General Components International, Logistics Plus, and GLB Solutions.
Next up, we have KKR paying $83.5 million for a Northeast Philadelphia industrial property. They paid just over $295 per square foot for the 282,000 square foot industrial property at 9801 Bluegrass Road in Northeast Philadelphia. The New York investment manager bought the property from DH Property Holdings, also of New York, which had built it in 2022 using a $76.8 million loan that was provided by Invesco Real Estate and Webster Bank. The property sits on a 22-acre site near the intersection of Grant Avenue and Roosevelt Boulevard and is fully leased to TJX Companies, the parent company of TJ Maxx, Home Goods, and Marshalls. CBRE arranged the sale.
Yeah, so it's really cool to see that TJX companies benefiting, providing value, not just on the retail side, but also in the industrial sector. I mean, we've talked about several stories over the last 12 months, Stephen, where those TJ Maxx, Home Goods, Marshalls, Ross Dress for Less type of retail centers are selling for really high prices. It seems there's an appetite for them on the industrial side too, for their distribution network. $295 a square foot is a really strong price. We have another one here that comes to us from the South Florida Business Journal. East Capital Partners bought the Skylake Executive Center. This is a 210,000 square foot industrial property in Miami. They paid $48 million or roughly $228 a square foot. East Capital is a Darien, Connecticut real estate investment firm, and they bought the property from Skylake Executive Industrial Park, LLC. Axiom Capital Advisors brokered the deal. Skylake Executive Center consists of 7 buildings. It sits across 11 acres, has addresses ranging from 19501 to 19599 Northeast 10th Avenue. It was constructed between 1980 and 1985. And I think we have one other industrial story out in Arizona, Stephen.
An affiliate of TA Realty paid $75.6 million or $187 a square foot for Chandler Air Park 202, a 402,000 square foot industrial property in the Phoenix suburb of Chandler, Arizona. TA Realty is a Boston investment manager, and they purchased the property from U.S. Capital Development of St. Louis in a deal brokered by Cushman & Wakefield. The property is at 1640 to 1700 Northrop Boulevard, and TA Realty acquired the property through its TA Realty Value Add Fund 13, which closed in 2023 after raising $1.8 billion of equity commitments. The fund pursues investments in industrial and multifamily properties, as well as grocery-anchored retail centers throughout the country. Chandler Air Park 202 is just more than 57% occupied.
This is definitely a value add play here. At 57% occupancy, less you're seeing the low sales price per square foot at $187 a square foot. I will say this is the first time I think we've had 2 Chandler, Arizona stories in one podcast. So we've gotten an industrial story and a retail story from Chandler, Arizona. I mean, I love seeing these TA Realty Value Add Fund, 14, and then just seeing the numbers associated with these funds, Stephen. I mean, it's remarkable. I know you and I have been in the business a while, and it used to be if you raised $1 billion fund, that was something, absurd. And now you have an industrial value add fund that's raising almost $2 billion worth of equity commitments. And so they'll be putting that money to good use and buying some of these industrial properties that need to be turned around in a very strong industrial market. So we'll be reading about this one, I'm sure, over the coming months as they lease this center up and generate some buzz for it.
And then lastly, in our lodging section, we have 2 stories about two different San Jose hotels, but both seeing their values reduced.
So this is an interesting segment, Stephen, in the sense that the San Jose hotel market has been fairly strong relative to maybe what we've seen in San Francisco and some of the other California marketplaces. But you're starting to see a little bit of that contagion maybe impacting these hotel assets negatively. So property behind a $13.6 million Wyndham Garden San Jose loan experienced a reduction in the appraised value. This asset's 196 key full service hotel built in 1969 and renovated in 2012. So the property was appraised at 32.1 million at securitization in 2014. It's seen its share of value fluctuations over the years, was most recently lowered to a value of 16.3 million this year in 2024. It had seen a value of 20 million back in 2023. So just the timeline on this, 2014 total value of 32.1 million, 2023 value of 20 million, most recently in 2024 value reduced again to 16.3 million. Still above the loan balance of 13.6 million, but not a great sign here. This loan is currently 30 days delinquent, but if you look back at the history, it's had its fair share of delinquency over that time period as well.
Yeah, and just one other interesting point to throw out here is that I'm reading the servicing commentary on this, and just an interesting little tidbit. This is currently a Wyndham Garden Hotel, but it was an unconsented conversion from a 4 Points by Sheraton.
We don't talk a lot. We could probably do it. We haven't done a 101 session in a while. Maybe we do in the next week or two and talk about hotel flags and conversions and just kind of what that means, because there's definitely some value implications, especially if something is converted without consent.
So just to wrap up here, we have one other San Jose hotel to talk about that had a value reduction again. The hotel behind the $16.5 million 4 Points by Sheraton San Jose has received another reduction to its appraised value. So the collateral is a 207-key hotel in Santa Clara built in 1990 and renovated in 2012. In March, we wrote that the hotel's appraised value had dropped below the outstanding loan balance of $16.1 million. September data shows that the value has been lowered further, now to $13.5 million. The hotel was valued at $46.5 million at securitization in 2014 before falling to $27.1 million in 2020. Several more reductions have followed since then, with the most recent appraisal cut coming in again at $13.5 million. So a really strong drop from the initial value about 10 years ago at $46.5 million. The loan transferred to the special servicer in October 2022 and has since been in and out of delinquency in recent months. So interesting little tidbit here. Once again, the servicing commentary on this loan also states that the hotel is now branded a Wyndham Garden Hotel as a result of an unconsented conversion from a 4 Points hotel by Sheraton. Tying these two loans together, these do actually share the same loan sponsor.
Okay, so for programming notes this week, we have a very busy week next week at Trepp with teams that will be in different areas across the country, but also a lot of events happening on the same day. So on October 16th, we actually have an event in our office that our own Susie S., who you've heard mentioned on the podcast many times, brought to us. She is an alumni of University of Rochester, and the University of Rochester Real Estate Group is hosting an event in our office, actually, where they're going to have David Streicher of Rockwood Capital talking about the 25 Water Street conversion from an office to residential. We'll be sharing some data and insights and hearing his take on what's going on with that property in Manhattan's financial district. So if you're interested and you're in New York City and you want to come by, send us a note to podcast@trepp.com. We have a few seats available. You don't have to be an alumni to attend, but it might be a great chance for you to network. And if you're interested in this space, learn about a real project that's happening. And that same day, we will have a team of people in Los Angeles at the SIOR event. Lonnie, you'll be speaking on a panel there, I think, diving into all of our CMBS distress metrics and really painting the picture of what's happening behind the scenes for the audience. We'll have all of our commercial real estate team there talking to attendees, meeting with people that we met with back at CREI Summit and in other conferences. So we're really excited to reconnect and chat with you there. If you're going to that event and want to meet, send us an email and we can set something up. And then also that same day in New York, we will be taking part in the New York City Real Estate Expo. So we're really excited. This will be our first time taking part in that event. We know it's a huge event. So if you're there, send us an email so we could try to find time to connect beforehand because it's a one-day event. We have to give a big shout out to Anthony Kay, who's the coordinator and founder of this event. He's been working with us diligently to make sure we can take part in it. We can interview people for our podcast and get in front of a lot of important players in the industry. And then right after those few events, we also will have a team of our employees at ABS East in Miami, October 21st through 23rd. This is on more of the structured finance side of our business, but if you're going to be at that event, send us a note and we'll make sure to catch you there. We also released a special episode of the TreppWire Podcast. We partnered up with the team at the Massimo Group, Rod Santamassimo and Mike Gallegos. We wanted to kind of take a step away from the data and give some motivation and insights into the practice of being an exceptional CRE broker. They coach some of the top CRE brokers in our industry. If you're a broker or hoping to become a broker someday, listen to that episode, check them out, and let us know your thoughts. And then I think last programming note for me, or maybe two more, we have some very exciting programs at Trepp, and one of them is our Future Leaders program, where we actually highlight and allow some individuals in the commercial real estate space who are just starting out or who are getting their degree to be highlighted across Trepp's channels. So if you are an upcoming December 2024 graduate studying commercial real estate finance, or anything of that sort, and you want to be a Trepp future leader, send us an email and we'll send you the information to apply to become part of that program. And a piece of material that is always highly read and a great summary is our quarterly data review with Commercial Real Estate Direct. We have that coming out towards the end of October. We'll have a huge focus on office because that's what a lot of the data and the trends we're pointing to, but we have some interesting insights in that publication. It will be distributed all across Trepp's channels. If you're interested in learning more about that report in general, or maybe even advertising in it, we do have some openings still left before that goes to publish. So send us an email to podcast@trepp.com. If you haven't learned, we have advertising slots on this podcast too, across our Commercial Real Estate Direct channels, and we'd love to partner with other listeners and players in the industry if you're interested. And then shout outs. I think my first shout out of this week has to go to our very own Lonnie Hendry. It is 10/10 and October 10th is his birthday. So we are going to embarrass you and give you a shout out in front of all of our listeners so that hopefully they flood your LinkedIn and flood your inbox with some happy birthday messages.
Thanks, Haley. I'll take the birthday wishes. Big 43 this year, so we've had a great run at Trepp, and I'll tell you, I've enjoyed every minute of it, and thankful for every birthday at this point. So going to be pretty low key, but thankful to not be traveling on my birthday. Was able to get back from some New York travel late last night and get home in time to do the podcast. So thanks for the birthday wishes, and thanks for everything that you and Steven do to make this such a fun endeavor for us.
Lonnie, I got to say, you're looking really dapper today. Like particularly like well put together. So I got to say, kudos to you. It's always great to look good on your birthday, and you do, my friend, you do.
Thank you. There's a saying. It's like look good, you feel good, you feel good, you do good, you do good. It's good, right? So that's kind of what I'm rolling out with today. So glad that this foundation or whatever I put on to try to make myself look good on this audio only podcast has worked.
And I think you said you get to sleep at home in your own bed for 6 whole nights before being in a hotel room. So that sounds like a great birthday present to me. But I know on the road.
Definitely excited to not be like living out of a suitcase for a few days. So it's good times this week.
And sticking with shout outs, we heard from Robert M. this week. He said, on this week's podcast, we made several references to self-storage data. I think we sent you that data. He said data like this is rare, so we're happy to give you some color into that market. And if anyone missed that episode, I think it was 2 or 3 episodes ago, we probably put it in the title, so take a listen to that episode if you're curious about the state of that market. Manish A., who is a loyal listener and a client of ours, was interested in some of our criticized multifamily data that we pull out from our bank consortia. And they also were interested in learning which large loans caused the delinquency rate to pick up for the retail property type last month. We don't always share that, but if you're a client, we can give you that behind the scenes info and really give you some color on why a rate increases. Was it really just due to one large loan becoming delinquent, or what's happening behind the scenes? Devlin C. said they often hear references to our anonymized bank loan and distress data and was wondering where they can get some of these stats. We'll follow up with you. We have a consortia that banks contribute their data to. If you're a bank listening and you want to contribute your data, we would then also give you the findings. So reach out to us. We could see how we can get you involved. Tom C. reached out and asked us what SASB meant again. Honestly, that is a fair question. We use a lot of acronyms on this podcast, and sometimes we have to take a step back and define them. So if you ever hear us talking about something and you want more color, send us a note. We have a lot of training and education materials out there already, so we probably have something we could send you, or we might just be able to go more in depth on a future episode.
And the timing on that is great. I just presented at the Chapel Hill Commercial Real Estate Data Symposium last week, and that exact same question came up. So, Tom, just very briefly, SASB stands for Single Asset, Single Borrower. Now, these are deals CMBS deals that are backed by either one single large asset, say like a trophy property, or a portfolio of deals or multiple loans backed by a single borrower.
And they've been prolific over the last 18 months or so. There's been an inordinate amount of SASB issuance given just where we're at in the distress cycle. So those trophy assets, really strong sponsors, have been viewed very favorably in the constructs of the CMBS origination market.
Yeah, that's accounted for almost 2/3 of CMBS or private label CMBS securitization volume this year alone. I have a quick shout out this week. I want to give a huge thank you to the folks at UNC Chapel Hill, and specifically the Commercial Real Estate Data Alliance Symposium that was run by Jacob S. over at UNC Chapel Hill. Thank you, Jacob, for having me and our fellow panelists, Rebel C, John W, and Joe N out last week. That was a fantastic, fantastic discussion and always one of my favorite conferences to go to.
And I just wanted to close with a shout out to our Trepp teams. We just spent the past few days in Asbury Park, New Jersey at our annual sales offsite event. We have all of our departments come together and really kick off our new fiscal year. We talk strategy, our game plan, and all the exciting, cool things we're working on. So it was a great way to come together. Our teams really pulled together a great event. And I'll have to add that a lot of our salespeople mentioned to us that when they get on the phone with you guys and new prospective clients, they're hearing that a lot of people have found Trepp through the podcast. So very cool to hear. And really, I want to just send a thank you out to our listeners as well for being so ingrained in what we do here at Trepp. We have such an awesome team of employees, and it's great to be able to tie our podcast back into all of the work that we're doing as a data company. So big shout out to our teams and our listeners. And if you're a listener who found us through the podcast, but then also became a client, send me a note because we may have to report that up and let everyone know. All jokes aside, thanks to everyone for tuning in every week, and thanks to our teams at Trepp for sharing this show and sending it out to your networks. So with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.